Two people, same day, same amount, both invested $5,000. One put it into an S&P 500 index fund. The other put it into a new crypto token that was trending on social media as the next Bitcoin. A year later, the first person's investment was worth $5,800. Steady, boring, predictable growth. The second person's investment. Within the first 3 months, it hit $15,000. He told everyone he knew. He genuinely considered quitting his job. 3 months after that, the same token was worth $1,200. Same starting amount, same time frame. Two completely different outcomes. This video isn't here to tell you crypto is a scam, or that stocks are the only safe choice. It's for anyone about to make their first real investment, trying to cut through a debate where most of what you'll find online is either selling you crypto, or scaring you away from it entirely. So let's skip the hype, and just look at the actual mechanics. Why this question matters right now. As of 2024, over 28% of American adults report owning some form of cryptocurrency. At the same time, more Americans than ever are investing through retirement accounts and brokerage apps. Over 60% of U.S. households now own stocks in some form, directly or through retirement funds. Both worlds are pulling in huge numbers of first-time investors, often without a clear understanding of how fundamentally different these two asset classes actually are, underneath the surface. And the choice you make first doesn't just affect your returns. It shapes how you understand risk, patience, and markets for the rest of your invested life. That's why this decision matters more than it might seem. How each one actually works. Let's start with the core mechanism, because everything else builds on this. How the stock market works. When you buy a stock, you're buying partial ownership of a real business. That company generates revenue, employs people, sells products or services, reports audited financial statements to regulators, and often pays dividends. The stock price is, in theory, a reflection of that company's actual performance and future earning potential. Stocks can absolutely be volatile in the short term. But underneath that volatility, there's a real, measurable economic engine, a business, generating the value. How crypto actually works. Cryptocurrency operates on a fundamentally different logic. Most cryptocurrencies have no underlying company, no revenue, no profit, and no legal claim on any real-world asset behind them. Their value comes almost entirely from supply and demand, how many people want to hold it, versus how much of it exists. Bitcoin, the most established cryptocurrency, derives value partly from scarcity, a hard cap of 21 million coins, and network effects. But thousands of smaller tokens derive their value almost entirely from the expectation that someone else will want to buy them for more later, something economists sometimes call the greater fool dynamic. This is the core distinction. A stock is backed by a business that can generate value even if nobody buys the stock tomorrow. Most crypto tokens are backed almost entirely by continued belief. The hidden math, risk and volatility in real numbers. Now let's look at numbers most people never actually check. The S&P 500's historical annualized volatility sits around 15 to 20%. That means in a typical year, the index tends to move within roughly the range, up or down. Bitcoin's historical volatility runs significantly higher, often in the 60 to 80% range annually. Smaller, newer tokens can see volatility well above that, sometimes exceeding 150% in a single year for one asset. Here's what that means practically. If you put $10,000 into an S&P 500 index fund, even in a severe crisis year, like the 2020 COVID crash, you might have seen it drop to around $7,000 to $8,000. Painful, but historically recoverable within a reasonable time frame. That same $10,000 is small, newly launched crypto token consistently dropped to $1,000 within a matter of weeks. And this isn't a rare and freak event in crypto history. It's happened to you. There's also a regulation gap worth understanding. The stock market has circuit breakers, SEC oversight, and strict rules against insider trading and market manipulation, actively enforced. Crypto markets, especially for smaller tokens, have documented repeated cases of pump and dump schemes and wash trading, largely because regulatory oversight is still catching up. None of this means stocks are risk free. It means the structure of the risk is fundamentally different between the two. Hype versus reality. To get rich quick illusion. The dominant narrative on success stories, there are far more people who lost significant savings, especially during the 2020 crypto crash, when the total crypto market fell from around $3 trillion to under $800 billion, a roughly 70% collapse in a matter of weeks. Here's the irony we're sitting with, the exact pattern that goes viral by this coin now. It's about to 10x and mirrors almost every speculative bubble in financial history. The difference is that in crypto, this cycle can play out in months, where traditional bubbles historically took years to build and burst. Stocks aren't immune to bubbles either. The dot-com crash proved that clearly. But investing in a diversified, established stock index and investing in a newly launched, unproven crypto token belong in genuinely different risk categories. Treating them as interchangeable options is where most beginners go wrong. Tax comparison, what most beginners never check. This part rarely gets discussed, and it meaningfully affects your actual, real-world returns. How stocks are taxed in the US. If you hold a stock for more than 1 year, any profit qualifies as a long-term capital gain, taxed at preferential rates to 0%, 15%, or 20%, depending on your income bracket. Sell within a year, and it's taxed as a short-term capital gain. At your regular income tax rate, which can run significantly higher. Also, historically, been a notable gap. Unlike stocks, crypto has not been subject to the wash sale rule, which normally blocks investors from selling an asset at a loss and immediately buying it back just to claim a tax deduction. This has allowed some crypto investors an aggressive tax strategy available in the stock market, though regulators have proposed closing this gap, and it's worth checking current rules before relying on it. Zooming out, the real question for a beginner. What kind of risk are you actually prepared to set with the slower, more predictable growth, or high variance, unpredictable swings that can move dramatically in either direction? The second repeatedly warned that cryptocurrency remains a highly speculative, largely unregulated asset class. That doesn't mean it can't be part of a portfolio, which is generally not the foundation that beginners build their financial future while they're still risk-taking. Most experienced investors follow simple structural principles. Build a stable, diversified base first, typically through low-cost index funds matched to your actual risk comfort. Then, if you're interested, allocate a small portion you could genuinely afford to lose entirely toward higher risk, speculative assets like crypto. This isn't a guaranteed formula. It's simply a framework that helps manage risk while you're still building your own understanding and comfort with how markets actually behave. The closing thought. So next time someone tells you crypto is where the real money is made, or that stocks are too slow to bother with, both statements carry a piece of truth, but neither tells the full story. Speed versus predictability is a trade-off every investor has to weigh for themselves, based on their own risk tolerance, timeline, and financial goals. No YouTube video, and no influencer, can make that decision accurately for you, because none of them actually know your full financial situation. So this video ends not with a recommendation, but with a question worth sitting with. If you genuinely don't know whether investing will drop 70% in 6 months, are you actually